The world of Bitcoin is currently fractured by a silent civil war. On one side stand the veterans, swearing that a catastrophic crash is imminent based on historical cycles. On the other, Wall Street giants claim that this time is different, driven purely by global liquidity. Most investors are blindly picking a side without understanding the battlefield. This ignorance is precisely why portfolios bleed when the market shifts, leaving you exposed to a reality you didn't foresee. To protect your capital and navigate this uncertainty, you must look beyond the noise and understand the colliding forces of history and institutional money. We will dismantle the conflicting arguments, analyze the 4 realistic scenarios for the coming months, and provide specific action plans based on your portfolio size. The market has evolved, and your strategy must evolve with it. Let's examine the data that separates the gamblers from the prepared. If you have been watching the charts lately, you might feel a distinct sense of confusion or even disappointment. We are hovering just under the $100,000 mark, yet the explosive energy of the past seems entirely missing. In previous cycles, this specific price level would have triggered mass euphoria and wild daily swings. Today, the movement feels heavy, slow, and strangely calculated. It is easy to mistake this new stability for weakness, but that is a grave error in judgment. To understand this shift, we must strip away the surface noise. The capital moving the market today is fundamentally different from the money that drove 2017 or 2021. Back then, the narrative was controlled by retail investors, people driven by emotion, chasing green candles on social media. Today, the dominant volume comes from spot ETFs, pension funds, and corporate treasuries. These giants do not buy because of FOMO. They buy based on strict mathematical models and rebalancing rules. Think of Bitcoin's evolution like a vessel at sea. 10 years ago, it was a small speedboat, easily tossed about by the smallest waves, capable of incredible speed, but prone to capsizing. Now, with trillions in institutional capital involved, it has become a massive ocean liner. It is far harder to turn and takes much more energy to move, but it is also significantly harder to sink. We are no longer in the chaotic, speculative phase. We have entered a phase of heavy, industrial momentum. The consequence of this maturation is that Bitcoin has lost its isolation. It is no longer a niche cypherpunk experiment detached from the real world. It is now a fully integrated macro asset. When the Federal Reserve adjusts interest rates or global liquidity tightens, Bitcoin reacts in sync with the Nasdaq and the S&P 500. The volatility has dampened because the market is efficient. We are seeing less explosive upside in the short term, but we are gaining systemic legitimacy. For you as an investor, this means the strategy of buy and pray is obsolete. You cannot expect the lottery ticket returns of the early days within a single week. Patience and understanding macroeconomics are now your most valuable tools. However, even with this newfound maturity, there remains a group that disagrees entirely. They argue that despite the suits and the banks, human nature has not changed and a reckoning is due. This brings us to the dark warning from the veterans. You have likely heard the whispers from those who have been here since the beginning. It creates a specific type of anxiety, doesn't it? When you see the price stall, you wonder if the floor is about to fall out. This fear is not irrational. It is born from memory. The veterans of this market are not looking at the ETFs or the news headlines. They are looking at a pattern that has repeated 3 times before, warning that what looks like stability is actually a trap. The logic behind their warning is rooted in the immutable mechanics of the protocol itself. Bitcoin operates on a rigid internal clock known as the halving, which restricts supply every 4 years. This supply shock triggers a frenzy, but gravity always reasserts itself. It is not magic. It is simply human psychology playing out on a digital ledger. Greed drives the price too high, and fear eventually drags it down. This cycle has never failed to execute its code. Imagine the market not as a straight line, but as the changing of seasons. You cannot stop winter from coming simply because you enjoyed the summer. The trees must shed their leaves to survive the cold, just as the market must shed its excess leverage to remain healthy. The veterans see the current price action as the late autumn chill. The air is crisp, the days are getting shorter, and while the sun still shines, they know the snow is inevitable. If this historical rhythm holds true, the implications are severe for those unprepared. We are looking at a potential correction of 30 to 50% from these levels. In 2013, 2017, and 2021, the exact same euphoria preceded a brutal collapse. To the veterans, the current institutional inflows are irrelevant noise against the deafening signal of history. They believe the market must bleed to reset, regardless of who is buying. The pattern demands respect. Your response to this thesis should not be panic, but armed preparation. If winter is indeed coming, you do not run, you simply put on a coat. You must acknowledge that the cycle is a powerful force, but it is no longer the only force at play. There is a new variable in the equation that the veterans might be underestimating, a force with enough capital to potentially stop the winter from ever arriving. Let us turn our eyes to the institutional argument. Have you ever wondered why the market sometimes ignores the news? You see a bullish headline, but prices drop, or bad news hits and prices soar. It feels like the game is rigged, doesn't it? That is because the players have changed. The institutions entering this space do not care about the 4-year cycle or the romantic history of crypto. They operate on a completely different set of rules, and their perspective is not about scarcity, but about the flow of the dollar itself. Here is the cold reality they operate by. Liquidity is the only thing that matters. When central banks lower interest rates and print money, assets rise. When they tighten the supply, everything falls. It is a mechanical relationship. To these giants, Bitcoin is simply a high-beta technology stock, reacting exactly like the Nasdaq. The internal mechanics of the blockchain are secondary to the external pressure of the global monetary supply. The halving is just a detail. Liquidity is the engine. Think of global markets as a series of interconnected swimming pools. Bitcoin is just one pool among many. When the central banks turn on the main hose, the water level rises in every pool simultaneously, regardless of their individual shape. You cannot have a drought in the stock market and a flood in crypto at the same time anymore. The pipes are now connected. If the water flows, boats float. If the tap runs dry, even the best ships will touch the bottom. The implication of this connection is profound. It means the old patterns you memorized might be broken forever. If we enter a period of massive monetary expansion, the traditional post-peak crash may never happen. Conversely, a liquidity shock could crush the price even during a supposed bull run. Bitcoin has graduated from being a rebellious outsider to a correlated macro asset. It is no longer dancing to its own tune. It is moving in lockstep with the global economy. So, where does this leave you? You cannot simply rely on the old maps, but you also cannot blindly trust that this time is different. The truth lies somewhere in the tension between these two forces. We must stop trying to predict a single outcome and instead prepare for the range of possibilities that liquidity dictates. This uncertainty demands a new framework. Let us look at the 4 specific scenarios that are most likely to unfold in the coming months. Most investors torture themselves trying to predict the exact future. You wake up checking the price, hoping you guessed right, fearing you guessed wrong. It is an exhausting way to live, isn't it? The truth is, this anxiety comes from a false belief that you need a crystal ball to make money. You don't. The professionals do not predict, they prepare. Instead of gambling on one outcome, we must map out the terrain. There are only 4 paths ahead. Let us strip away the fantasy and look at the probabilities. First, we might see a boring lateral range where institutions quietly accumulate. Second, a moderate correction of 20% could oxygenate the market. Third, the veterans might be right, leading to a severe crash if liquidity dries up. Finally, a surge in global money could trigger a massive breakout to new highs. These are not guesses. They are simply the 4 corners of the playing field. Imagine you are a captain sailing into unknown waters. You do not know if you will face a storm, a dead calm, or a favorable tailwind. A foolish captain bets everything on fair weather and sinks when the storm hits. A wise captain reinforces the hull for the crash, stocks supplies for the calm, and raises the sails for the wind. You must rig your ship to survive the worst waves while being ready to catch the breeze the moment it finally arrives. The consequence of ignoring these scenarios is financial fragility. If you bet solely on up only, a severe crash destroys you. If you sit in cash waiting for a collapse that never comes, inflation erodes your wealth. The market is an efficient machine designed to transfer money from the reactive to the proactive. By accepting that any of these 4 realities can happen, you remove the element of surprise. You stop being a victim of the charts. Now that you see the map, you can stop trembling at the unknown. The question changes from "what will happen?" to "is my portfolio robust enough for anything?" This requires a shift in mindset, but more importantly, a shift in tactics based on who you are. A beginner cannot trade like a whale, and a whale cannot take the risks of a beginner. To survive what is coming, we need to tailor your strategy specifically to your capital and experience level. Have you ever felt paralyzed by the conflicting advice screaming at you from every direction? One guru shouts to buy the dip with everything you have, while another warns you to sell before the collapse. It is confusing because they are likely not speaking to you. A strategy that makes a millionaire wealthier will often bankrupt a beginner, and what works for a student is useless for a retiree. You are trying to wear a suit of armor that was not measured for your specific body. Here is the brutal reality of wealth management. The size of your stack dictates your rules of engagement. If you are starting from zero or have a small portfolio, volatility is not your enemy. It is your only ladder. You need the price to swing so you can accumulate cheap assets via dollar cost averaging. But if you have significant capital, the game flips entirely. You are no longer hunting for a multiplier. You are fighting to prevent a 30% drawdown from destroying you. Think of your financial journey as building a massive skyscraper. When you are just digging the foundation, you want the ground to be soft and the materials to be cheap. You are in the aggressive acquisition phase. But once the tower is built and touches the clouds, your priority changes instantly. You stop caring about cheap cement and start worrying about the wind. You install dampers and stabilizers. The small investor builds the structure. The advanced investor protects it against the storm. This distinction is why the advanced player allocates differently. They hold 50 to 70% in the core asset, but they keep 20% in strategic cash and 10% in hedges. They do not fear missing the top. They fear losing the bottom. If you apply a preservation strategy while you are poor, you will stay poor. If you apply a gambling strategy when you are rich, you will become poor. Matching your tactics to your reality is the only way to endure the cycle. So identify your position on this board today. If you have nothing, start buying small amounts weekly. If you are building, automate your discipline and ignore the noise. If you have arrived, secure your perimeter. Do not let greed push you into a game you have already won. By choosing the correct path, you stop guessing and start executing. Now that you have your battle plan, there is one final philosophical truth we must address before we part ways. We have traversed the landscape of fear and liquidity together. You no longer need to be paralyzed by the conflicting shouts of veterans predicting doom or institutions promising infinite gains. You now understand that the truth is a tension between these opposing forces, and you possess the maps for every possible terrain. The anxiety of the unknown has been replaced by the quiet confidence of strategy. You are no longer guessing, you are waiting to execute. Remember that the market is not a casino, although many treat it as one. It is a mechanism for transferring wealth from the impatient to the prepared. The specific price of Bitcoin tomorrow matters far less than your ability to survive the decade. No one knows exactly what will happen next, and anyone claiming certainty is lying. But as we established, the future always rewards those who prepare for the storm, never those who simply hope for the sunshine. If this analysis provided you with the clarity required to navigate these waters, consider joining us for the next briefing. We do not deal in hype here. We deal in the signals that actually move the needle. Subscribe to ensure you are never left reacting to the news after it has already happened. Tell me in the comments, which scenario do you believe is unfolding right now? I will see you in the next video. Stay sharp and trust your plan.